Hi, clients and friends. This is Chad Roope, Chief Investment Officer here at Lineweaver Wealth Advisors. We proactively placed trades recently in the equity dividend strategy that we manage for you, and so we wanted to offer a short update. Overall, this strategy has performed very well this year so far, and it's outpacing even the S&P 500 index with less volatility. The overall strategy with equity dividend is to invest in high quality companies that have strong management, competitive positions within their industries, and that really show growth in cash flow and importantly, growth in dividends over time. And we strive to deliver a 7 to 10% annual dividend growth at the portfolio level. And we think that's really compelling in this environment. We do like this strategy also looking forward and think it's a good place for any excess cash that you may have sitting on the sidelines. This year has been presented a wide variety of political, social, and economic instability. However, we generally remain cautiously optimistic because of fairly easy financial conditions and fiscal policies that continue to be generally supportive for equities overall. There are several items that we think could create some volatility moving into the latter part of the year here, such as the S&P 500 earnings. We're coming off a great quarter where earnings exceeded expectations, but we think those expectations might have to start coming in some as we potentially see the economy slow into the fall. Secondly, markets are very highly concentrated right now. For example, NVIDIA, Microsoft, and Apple, the three biggest companies in the S&P 500, they make up about $11.5 trillion when you put the three together in value. That's nearly 22% of the entire S&P 500 index, one of the most closely followed indices worldwide. The NASDAQ Composite Index, for another example, its market value right now, if you take all the companies in the index and put their values together, it's over 100% of the $30 trillion U.S. economy, a number we've never seen. At the height of the dot-com bubble in 2000, the NASDAQ was about 60% of U.S. GDP. Now it's over 100. So I think this just highlights that the markets are really honed in and focused on these big cap tech AI related names. And we think this creates concentration risk. And we want to be proactive in managing that. Labor markets and service sector data has recently shown some weakness as well. And we know that consumers, you and me, out spending money, that's about 2/3 of the U.S. economy. And so we really are mindful of the labor markets and service data. Fourth, tariffs are likely to push inflation higher in the short run. We don't think it's a long-lasting thing, but we're going to get a bump most likely as companies push that inflation through to you and me. And that could pinch consumers and could slow the revenue growth potential of companies. Part of the reason we're talking about potentially slowing earnings expectations in the last part of the year here. Lastly, stocks appear overvalued presently. The S&P 500 is trading at about 22 times forward earnings, and that's way above its longer-term average of about 17. So, the economy is going to have to stay resilient, and the AI spending is going to need to continue to grow to support these current valuation levels. So, as a result of all that, we've simply taken some profits and slightly reduced some holdings that are the big AI tech names like Broadcom, Corning, Microsoft, and so on in your portfolio. And we rotated those proceeds to sectors that may play catch up moving forward, such as healthcare stocks, energy stocks, and consumer staples. We also added a new position in IBM, one of those tech stocks that has recently pulled back actually from its highs, and we think it provided a pretty good entry point. So it gives us a little bit more diversification in the tech sector, trimming some of the high flyers and adding to some that we think can play catch up within the tech sector as well. Finally, we just increase our cash holdings just a little bit for dry powder in case we see some volatility in September, October, which are typically some of the more volatile months in the calendar year. So, we think this active style of investing allows us to be nimble in managing your portfolios to take advantage of opportunities and protect when volatility emerges. So, we always appreciate your confidence and, in our seasoned team of investment professionals here at Lineweaver Wealth Advisors. The greatest compliment you can give to us is to refer, new family and friends to us that can benefit from our comprehensive services here. So please use the link included in this email and share it with anyone you think that may benefit from learning more about our active management that we just talked about, as well as the coordination that you're accustomed to with financial, tax, legal, and insurance needs. So thank you for your time, and we'll be in touch again shortly. Thank you.